Welcome back. Today we continue to present Section D questions from the first part, Cost Management. Follow the channel to receive all the questions. Soon we will be working on covering the 2023 questions from multiple sources. Please follow the channel to support us. Let's get started. Question 1. For MS Company, at a sales level of 4,000 units, sales are $75,000, variable expenses total $50,000, and fixed expenses are $21,000. What is the contribution margin per unit? A. $5.25. B. $6.25. C. $12.50. D. $18.75. The answer is B. $6.25. Contribution margin per unit is calculated as sales price per unit minus variable cost per unit. The calculation is $75,000 divided by 4,000, $50,000 divided by 4,000 equals $6.25. Question 2. Which one of the following considers the impact of fixed overhead costs? A. Full absorption costing. B. Direct costing. C. Prime costing. D. Variable costing. The answer is A. Full absorption costing. Full absorption costing considers direct material, direct labor, and both fixed and variable overhead costs as product costs. The other methods noted consider fixed overhead to be a period cost rather than a product cost. Question 3. If a firm was more concerned with reliability of data than with the speed at which the data is available, which of the following costing methods would be the best fit? A. Variable, direct, costing. B. Standard costing. C. Actual costing. D. Normal costing. The answer is C. Actual costing. An actual costing system uses actual costs, which are very reliable because they rely on actual invoices, but results are delayed due to the wait for invoices and other evidence. Question 4. Indirect and common costs often make up a significant portion of the cost of a product. All of the following are reasons for indirect cost allocation to cost objects except to A. Justify costs for reimbursement purposes. B. Measure income and assets for external reporting purposes. C. To conform to GAAP. D. Reduce total costs identified with products. The answer is D. Reduce total costs identified with products. Indirect cost allocation to cost objects include the measure of income and assets for external reporting purposes, to justify costs for reimbursement purposes, and to conform to GAAP. Question 5. Committed costs are costs that A. Management decides to incur in the current period that do not have a clear cause and effect relationship between inputs and outputs. B. Result from a clear measurable relationship between inputs and outputs. C. Establish the present level of operating capacity and cannot be altered in the short run. D. Are responsive to management's attention. The answer is C. Establish the present level of operating capacity and cannot be altered in the short run. Facility costs are committed costs resulting from past decisions related to establishing the firm's capacity level. A common definition of the short run is the time period over which capacity is fixed. Once capacity is altered, the firm is in the long run. Question 6. Property taxes are A. Committed direct cost. B. Discretionary indirect cost. C. Committed indirect cost. D. Discretionary direct cost. The answer is C. Committed indirect cost. Costs can be discretionary or committed. Committed costs are costs that cannot be omitted due to strategic or operational priorities. Property taxes are a committed cost. Indirect costs are costs that cannot be directly traced to a process or product, such as depreciation, taxes, salaries paid to salespeople, insurance, and lease costs. Question 7. Yard Beautiful Enterprises produces lawn mowers. The total cost for the month of June is $201,780. During June, Yard Beautiful manufactured 580 lawn mowers. If the variable cost for one lawn mower is $206 and the selling price is $475, what is the fixed cost for June? A. $201,780. B. $73,720. C. $82,300. D. $119,480. The answer is C. $82,300. Correct. The fixed cost equals the total cost of manufacturing minus the variable cost, therefore, the fixed cost equals $82,300, $201,780 minus 580 times $206. Question 8. Which of the following statements about cost objects is accurate? A. All costs are assigned to cost objects based on a consumption relationship. B. All costs are assigned to cost objects based on an allocation method. C. Cost objects can also serve as revenue objects for the organization. D. Cost objects are the same thing as expense objects. The answer is C. Cost objects can also serve as revenue objects for the organization. Correct. Typically, cost objects are tied to the organization's income statement and can also represent the revenue objects, i.e., what creates revenue, for the organization. Question 9. Which of the following statements accurately describes the cost behavior of variable costs in response to changes in business activity levels? A. Variable costs per unit change with increases or decreases in activity. B. Variable costs on a total and per unit basis both remain constant within the relevant range of activity. C. Variable costs on a per unit basis remain constant. D. Variable costs on a total and per unit basis both change with increases or decreases in activity. The answer is C. Variable costs on a per unit basis remain constant. Cost behavior patterns refer to how fixed and variable costs react to changes in business activity levels. For variable costs, the unit cost remains constant while the total cost changes with increases or decreases in activity. Question 10. All of the following items are considered manufacturing costs except for A. Tires for an automobile manufacturer. B. Sales commissions for a car manufacturer. C. Plant property taxes for an ice cream maker. D. Cream for an ice cream maker. The answer is B. Sales commissions for a car manufacturer. Manufacturing costs are those costs directly related to the production of the good. The answers include all costs associated with the production of a good, except for the sales commissions for a car manufacturer. Question 11. A plant meters electricity usage at the department level. The department has several product operations, including tennis ball manufacture. Electricity is considered which of the following for a can of tennis balls? A. A variable direct cost. B. A fixed indirect cost. C. A fixed direct cost. D. A variable indirect cost. The answer is D. A variable indirect cost. The electricity is a variable cost, because as the quantity of tennis balls produced is increased, electricity costs also increase. Indirect costs include electricity because it is metered at the department level and cannot be traced to the cost for a can of tennis balls in a cost-effective manner. Question 12. A manager is charting out the costs for a production process and finds that if she calculates costs at various expected production levels, the change in costs is constant. Above a very high level of sales, the rate is no longer constant. The latter portion is A. Outside the cost-benefit constraint. B. No longer a variable cost. C. No longer a fixed cost. D. Outside the relevant range. The answer is D. Outside the relevant range. The relevant range is the expected range for a cost driver such as a quantity or amount. Amounts outside the relevant range do not change in a linear fashion. Question 13. On April 1, 2016, Jensen's Auto has $542,194 in partially completed cars and trucks in their inventory. During the month of April, they incur the following costs. $167,588 to finish the vehicles. $1,274,639 to complete another 75 vehicles. $388,642 to start 40 more vehicles. What is the cost of goods manufactured for the month of April? A. $2,373,063. B. $1,830,869. C. $1,288,675. The answer is D. $1,984,421. Cost of goods manufactured is defined as beginning work in process inventory plus manufacturing costs incurred during the period, ending work in process inventory. The manufacturing costs incurred during the period consists of costs incurred to finished goods started in a prior period, costs incurred to start and finish goods, and costs incurred to start goods that are unfinished at the end of the period. Using the numbers for Jensen's auto results in costs incurred in April of $1,830,869, $167,588 plus $1,274,639 plus $388,642. Putting this into the cost of goods manufactured formula results in cost of goods manufactured of $1,984,421, $542,194 plus $1,830,869 minus $388,642. Therefore, this is the correct answer. Question 14. Which of the following is a variable cost? A. Capital expenditures. B. Rent. C. Manufacturing labor wages. D. Depreciation. The answer is C. Manufacturing labor wages. Variable costs can be increased or decreased in the short run. Wages can be increased or decreased by hiring or laying off workers during recoveries or recessions. Question 15. The Ramirez Company makes leather jackets that sell for $175 each. The total cost in May of manufacturing 1,000 jackets is $114,860. The variable cost for each jacket is $57. What are Ramirez's fixed costs for the month? A. $57,000. B. $114,860. C. $60,140. D. $57,860. The answer is D. $57,860. Correct. The fixed cost equals the total cost of manufacturing minus the variable cost. Therefore, the fixed cost equals $57,860, $114,860 minus 1,000 times $57. Question 16. A company has observed the following costs at different production levels. What are the cost behaviors of costs A, B, C, and D, respectively? Asterisk source, retired ICMA CMA exam questions. A. Variable, fixed, variable, mixed. B. Mixed, fixed, variable, mixed. C. Mixed, fixed, mixed, variable. D. Variable, fixed, mixed, variable. The answer is B. Mixed, fixed, variable, mixed. Cost behavior considers how the total cost paid for something changes, if at all, when output changes. A cost is fixed if the total amount paid does not change when output changes. A cost is variable if the total amount paid changes in direct proportion to the change in output. That is, total cost doubles when output doubles. A mixed cost has both a fixed and variable component. With a mixed cost, the total amount paid changes when output changes, but by a smaller percentage than output changes. That is, total cost does not double when output doubles. In this example, cost A and cost D are mixed since the amount paid for 50,000 units is more than for 25,000 units, but it is not double. Cost B is fixed because the same amount is paid for 25,000, 50,000, and 75,000 units. Cost C is variable since the amount paid for 50,000 units is double the amount paid for 25,000 units, and the amount paid for 75,000 units is triple the amount paid for 25,000 units. Question 17. How is the beginning work in process inventory related to the cost of goods manufactured? A. The beginning work in process inventory is calculated by subtracting the cost of goods manufactured from the ending work in process inventory. B. The beginning work in process inventory is calculated by adding the total manufacturing costs to the cost of goods manufactured and subtracting the ending work in process inventory. C. The cost of goods manufactured is calculated by adding the beginning work in process inventory to the total manufacturing costs and subtracting the ending work in process inventory. D. The cost of goods manufactured is calculated by adding the ending work in process inventory to the total manufacturing costs. The answer is C. The cost of goods manufactured is calculated by adding the beginning work in process inventory to the total manufacturing costs and subtracting the ending work in process inventory. Cost of goods manufactured is defined as the manufacturing cost of goods finished during an accounting period. It is also the amount transferred out of work in process inventory during an accounting period. It is defined as beginning work in process plus total manufacturing costs incurred during the period minus ending work in process. Therefore, this is the correct answer. Question 18. A company has the following cost information. Determine what amount of sales revenue would result in a contribution margin of $125,000. A. $365,000. B. $381,000. C. $300,000. D. $425,000. The answer is D. $425,000. Correct. Sales revenue minus total variable cost equals contribution margin. Sales revenue minus 20,000 times 12 minus 16,000 minus 44,000 equals $125,000. Sales revenue minus 300,000 equals $125,000. Sales revenue equals $125,000 plus $300,000. Sales revenue equals $425,000. Question 19. Taylor Corporation is determining the cost behavior of several items in order to budget for the upcoming year. Past trends have indicated the following dollars were spent at 3 different levels of output. In establishing a budget for 14,000 units, Taylor should treat costs A, B, and C, respectively, as A. Semi-variable, fixed, and variable. B. Variable, fixed, and variable. C. Semi-variable, semi-variable, and semi-variable. D. Variable, semi-variable, and semi-variable. The answer is A. Semi-variable, fixed, and variable. The cost behavior pattern over a relevant range of production would be semi-variable, fixed, and variable for cost A, cost B, and cost C, respectively. A relevant range is a range of production volumes where the range of activity for which the assumptions of cost behavior reasonably hold true and the range of activity over which the company plans to operate. Semi-variable costs are costs that are composed of both fixed and variable components. The variable component causes them to vary in total with changes in volume. The fixed component, however, prevents them from varying in direct proportion to the change in volume. Cost A is considered a semi-variable cost as it is variable in the sense that greater levels of production increase total cost, however the variable cost per unit does not remain constant regardless of production volume. As production increases, the cost per unit decreases. The cost per unit at 10,000 unit levels, 12,000 unit levels, and 15,000 unit levels is $2.90, $2.42, and $2.33, respectively. Cost B is a fixed cost of $15,000, as it remains constant at any level of activity. Cost C is a variable cost as it changes in proportion to the level of activity. Variable costs per unit remain constant regardless of production volume. The cost per unit remains at 67 cents when production is 10,000, 12,000 and 15,000, computed by dividing cost C by the applicable unit level. Question 20. Which best describes what happens to the variable cost per unit if activity is within the relevant range? A. It differs at each activity level. B. It stays the same at each activity level. C. It increases as production increases. D. It decreases as production increases. The answer is B. It stays the same at each activity level. Correct. Within the relevant range, the variable cost per unit is constant. Question 21. All of the following are period costs except A. Depreciation costs on the VP's company car. B. Drill bits for a drill press. C. Data entry costs. D. Sales commissions. The answer is B. Drill bits for a drill press. Drill bits for a drill press are product costs because they relate directly to production and provide measurable future benefits. Selling and administrative costs, advertising costs, data processing, and executive costs are all period costs. Question 22. LAR Company has found that its total electricity cost has both a fixed component and a variable component within the relevant range. The variable Component seems to vary directly with the number of units produced. Which one of the following statements concerning Lars' electricity cost is incorrect? A. The variable electricity cost per unit of production will remain constant as production volume increases. B. The total electricity cost per unit of production will increase as production volume increases. C. The total electricity cost will increase as production volume increases. D. The fixed electricity cost per unit of production will decline as production volume increases. The answer is B. The total electricity cost per unit of production will increase as production volume increases. Within the relevant range, the total electricity cost per unit of production will decrease, not increase, as production volume increases. This is because the variable electricity cost per unit of production will remain constant as production volume increases, and the fixed portion of the electricity cost per unit will decrease as production volume increases. The fixed cost per unit will decrease as production volume increases because the total fixed cost component of the electricity cost will remain constant despite the production volume increases. Question 23. The following cost and revenue information has been accumulated by Sailor Company for the most recent fiscal year. Operating income $250,000. Total selling and administrative expense $8 per unit. Cost of goods sold $550,000. Determine gross margin if operating income is 20% of sales. A. $800,000. B. $2,750,000. C. $700,000. D. $1,250,000. The answer is C. $700,000. Correct. If operating income is 20% of sales, then sales equals operating income divided by 20%. Sales equals $250,000 divided by 20%. Sales equals $1,250,000 of sales. Gross margin equals sales minus cost of goods sold. Gross margin equals $1,250,000 minus $550,000. Gross margin equals $700,000. Question 24. Product #92S sells for $50 per unit. Direct materials are $12, direct labor is $6, and variable manufacturing overhead is 60% of direct labor costs. Variable selling and administrative expenses average $8 per unit sold. If fixed manufacturing overhead is $140,000 when fixed selling and administrative expenses total $80,000, determine the total contribution margin when 25,000 units are produced and sold. A. $710,000. B. $510,000. C. $290,000. D. $570,000. The answer is B. $510,000. Correct. Contribution margin equals sales revenue minus total variable costs. Contribution margin equals 25,000 times $50 minus 25,000 times $12 plus $6 plus $3.60 plus $8. Contribution margin equals $1,250,000 minus $740,000. Contribution margin equals $510,000. Question 25. Peak Industries saw a 20% increase in activity levels over the fourth quarter. This increase is within Peak's relevant range of production. Which of the following changes should the firm expect to see in relation to this increase? A. A 20% increase in variable costs. B. A 20% increase in fixed costs. C. A 20% increase in total costs. D. A 20% decrease in variable costs per unit. The answer is A. A 20% increase in variable costs. Correct. Variable costs vary directly with changes in activity levels, so a 20% increase in activity levels would lead to an expectation of a 20% increase in variable costs. Question 26. In cost terminology, prime costs consist of A. Direct labor and variable factory overhead. B. Direct labor and direct materials. C. Direct materials and variable factory overhead. D. Direct labor and indirect labor. The answer is B. Direct labor and direct materials. Following generally accepted accounting principles, product costs consist of direct material, direct labor, and indirect manufacturing costs, overhead. Prime costs are defined as direct material plus direct labor. Question 27. A firm has $100,000 in direct materials costs, $50,000 in direct labor costs, and $80,000 in overhead. Which of the following is true? A. Prime costs are $150,000, conversion costs are $180,000. B. Prime costs are $130,000, conversion costs are $150,000. C. Prime costs are $150,000, conversion costs are $130,000. D. Prime costs are $180,000, conversion costs are $150,000. The answer is C. Prime costs are $150,000, conversion costs are $130,000. Prime costs are the combination of direct labor and direct materials costs. Conversion costs are the combination of direct labor and overhead costs. Question 28. In a decision analysis situation, all of the following costs are generally relevant to the decision except for A. Differential cost. B. Incremental cost. C. Historical cost. D. Avoidable cost. The answer is C. Historical cost. Historical costs are sunk costs. They have already been incurred and cannot be recovered in the future. Therefore, they are irrelevant for decision making. Question 29. Fairweather Industries manufactures umbrellas that sell for $17 each. The variable cost of each umbrella is $3.78. The company incurs monthly fixed costs of $7,000. If Fairweather makes 750 umbrellas in April, what is the total cost? A. $7,000. B. $2,915. C. $9,835. D. $2,835. The answer is C. $9,835. Correct. The total cost equals the variable cost plus the fixed cost, therefore, the total cost equals $9,835, $3.78 times 750, plus $7,000. Question 30. Which of the following statements is true concerning fixed costs, variable costs, and total costs? Within the relevant range. A. Fixed costs per unit increases as the number of units produced increases. B. Total cost per unit decreases as the number of units produced increases. C. Variable cost per unit increases as the number of units produced increases. D. Fixed costs per unit does not change as the number of units produced increases. The answer is B. Total cost per unit decreases as the number of units produced increases. While fixed costs, in total, stay constant over the relevant range, as output increases, fixed costs per unit declines. Since variable costs per unit is a constant, then total costs per unit must decline as the number of units produced increases. Question 31. Fowler Company provides the following summary of its total budgeted production costs at 3 production levels. The cost behavior of each of the costs A through D, respectively, is A. Variable, semi-variable, fixed, and variable. B. Variable, fixed, fixed, and variable. C. Semi-variable, variable, fixed, and variable. D. Variable, semi-variable, fixed, and semi-variable. The answer is A. Variable, semi-variable, fixed, and variable. Variable, semi-variable, fixed, and variable is the correct answer. Costs A and D are considered variable costs as they change in proportion to the level of activity. Cost B is considered a semi-variable cost as it is variable in the sense that greater levels of production increase total cost. If no production occurs, then a fixed cost is still incurred. Cost C is a fixed cost, as it remains constant at any level of activity. Question 32. Normal costing systems are said to offer a user several distinct benefits when compared with actual costing systems. All of the following are benefits associated with a normal costing system except A. A smoothing of product costs throughout the period. B. A more economical way of attaching overhead to a job or product. C. More timely costing of jobs and products. D. Improved accuracy of job and product costing. The answer is D. Improved accuracy of job and product costing. Normal costing systems offer the benefits of more timely costing of jobs and products, a smoothing of product costs throughout the period, and a more economical way of attaching overhead to a job or product. Normal costing does not, however, improve accuracy of job and product costing. Question 33. Which of the following is often changed on a day-to-day basis? A. Plant-wide overhead rate. B. Departmental overhead rate. C. Fixed overhead costs. D. Variable overhead costs. The answer is D. Variable overhead costs. Variable overhead costs can be influenced on an ongoing basis, unlike fixed overhead costs, which cannot be influenced by daily attention.